Well, the Reserve Bank provided me with a little bit of a shock with their most recent decision to raise interest rates. They have their cash rate now at 4.25%. We know that they believe that neutral cash rates, that's the level of the cash rate at which the interest rates are no longer helping or hindering the economy, is somewhere between 4.5% and 5%. The reason why we saw the rate hike, despite the fact that there was clear evidence that the interest rate sensitive parts of the economy are starting to slow down, I think the reason is that the Reserve Bank very much focused on property prices and on the likely boost the economy is going to get from the resources boom. The property price story is not that the Reserve Bank believes that we have a property bubble at the moment, and I certainly agree with that. I think the reasons why property prices are rising strongly at the moment relates to strong population growth, which is leading to shortages, decent affordability in Sydney in particular. So I think that their view there is that they don't want to be helping the property bubble, and helping the property bubble means that you've got interest rates below the neutral level. So I think they're on a bit of a mission really to get the interest rates back to their so-called neutral, which I think is now only about 0.25% away. So it's likely that we will see another 0.25% interest rate increase either in May or June. I think it's always more sensible to raise interest rates before a budget rather than after a budget. If you raise it after a budget, you run the risk of markets believing that you're formulating some sort of a view on the budget, whereas beforehand it's a lot cleaner. So I think May still looks like a decent chance, although the markets are quite in denial about that. They're only looking at around about a 25% chance. I think then we'll see a fairly long period of stability of interest rates, because we are starting to see some evidence already that those interest rate sensitive parts of the economy are starting to slow down. We're seeing retail sales is definitely on a downward trend at the moment. Residential building approvals are slowing down. New lending for housing is slowing down. And we're even starting to see a slowing trend in the number of new jobs being created. Doesn't mean we've got a very healthy jobs market, we do, but the real strength we saw at the end of last year isn't following through at the moment. And bear in mind that with the population growth, we need to generate about 25,000 jobs a month just to keep the unemployment rate steady. That's up from 15,000 when population growth was running at 1.25% compared to the current 2.25%. So I think that'll probably mean that the labour market won't be a negative or a positive for the economy over the next 6 months or so, but we'll see a good, steady, low unemployment. The global story is not as encouraging as the Australian story at the moment. I think we're starting to see the US housing market go backwards again. There's a real fear that when the fiscal stimulus starts to fade in the US and the build-up in inventories fade, that there won't be too much left in terms of strong internal domestic spending to keep growth at the sort of levels that the market is currently expecting. In Europe, we're seeing that the European growth has been very weak indeed. I think France was the only economy in the final quarter of last year that showed any growth at all. The Europeans haven't benefited from the big fiscal stimulus that the US has because their finances are very difficult, and of course we're seeing ongoing worries about contagion from the Greek problem, which at the moment seems to be stitched up, but there's ongoing fears of concerns in other parts of Europe. The China story continues to be strong, although our lead indicators are now pointing to a decent slowdown in China, back to trend from the sort of 10 to 12% growth pace that they had before. The issue there is going to be whether China has generated asset bubbles that the authorities are going to find difficulty in dealing with, or they're starting to see inflation. Now, the inflation that they're getting won't be anything like the sort of explosive inflation we saw a few years ago, but certainly the huge surge to liquidity that the Chinese gave their economy is undoubtedly creating certainly property bubbles in Shanghai and Beijing, and potentially more widely spread. Our best view of China is that it will continue to slow. However, they will achieve growth of around about trend growth, which will ensure that China remains a decent contributor to the global economy, but without a strong maintenance of growth in the US, Europe and Japan, global growth is going to remain at a below trend level. And I think from the perspective of equities, we've had a huge first year in this equity recovery. I'd be very sceptical that the second year is going to reach the sort of levels that people are currently expecting it to see, given my outlook for the global economy, and given my outlook that I think in the case of Australia we will see some slowing over the next 6 to 9 months.